Welcome back to the Investor Minded Framework. In this video, we're going to talk about learning the numbers. So this is where we can find out how to actually make the deal work on the cost side of things. So one of the first things we want to look at is the actual income of the property. How much does this property bring in? And that's something that the previous owner may be able to tell you. But at the same time, you also want to consider your local market. What is the average rent for this kind of property? One of the big tools that I use will be something like Rentometer to look up what is the data for my market. What are properties with this bed bath count bringing in over the last couple months? So that is something as simple as income. You also want to consider other accessories to the property too. Maybe you have garages that you rent out. Maybe you have separate spaces that you rent out. That's the amazing thing about real estate is there's so many different avenues you can go down with it. So income is where you're bringing in the money itself. Expenses is what costs you money. And those are things we've talked about in previous videos, such as all the people that are a part of your team. While they help you with every single part of the process, they also do cost something. And we want to ensure that that cost is worth it. So those are going to be your expenses. Those can be things like your mortgage, principal, interest, taxes, and insurance, your contractors, even things such as insurance and maintenance, capital expenditures, many of the things we're going to talk about in this video. We want to also move on to cash flow. With cash flow, we're taking our income and we're subtracting all those expenses from it, understanding what actually is this property making. And that's how we end up understanding what cash flow is. Then cap rate is where it gets to be a little bit more complicated. We want to look at cap rate, cash on cash return, and DSCR, some of the big three that honestly I got kind of hung up on starting out myself. We want to understand how all those matter. So we'll look at it like a lemonade stand. You have a lemonade stand that's bringing in money every single day. But we also want to understand with cap rate, for example, how good is the lemonade stand itself? Who cares the most is generally going to be the investors. They're looking at that house like a lemonade stand and they're comparing those lemonade stands as to how good does it stand on its own. Cash on cash return, we're also going to look at how hard is my money working. So that could be investors that are using financing. And then DSCR, can this stand to pay back the bank? And that's something that the bank is going to be looking at. So we're going to get into the cap rate itself. That'll help you understand the property quality. A lot of times when it comes to investment properties that are commercial, they'll advertise it with the cap rate as well. So imagine you have house A and it costs $100,000 to buy. And it makes $8,000 a year after operating expenses, but that's before the mortgage. So we're not even considering principal, interest, taxes, and insurance in that. So we want to understand that at that point, we're bringing in $8,000 a year on a $100,000 cost. We're not even worrying about financing at that point. We're just paying cash. So, what is this property bringing in if I were just paying cash? Because a lot of times with commercial financing, investors may just be paying cash for it. They may be reinvesting from another property, utilizing a 1031 exchange. They're taking cash out of one property and then buying another property, maybe with just cash. Cash on cash return is looking at your money, your investment. What is it bringing back? So after you've paid your mortgage, taxes, insurance, maintenance, all things considered, let's say you bought that same house, $100,000, and you've invested $20,000. You've got the 20% down payment, and you end up keeping $4,000 a year after expenses. So we understand that we take the amount of money that you've actually invested, so $20,000, and we've got the income that we have afterwards. So $4,000, we're going to divide it by $20,000, and we're going to understand that that's 20%. So if you invested a dollar, every single dollar you've invested is going to produce 20 cents this year. And that's why leverage can be so powerful as well. So if the property only has an 8% cap rate, but because you've invested $20,000 instead of $100,000, your cash return is actually much higher. This is the number that a lot of investors actually tend to care about. Now, DSCR is something that the lender will tend to care a lot more about. And oftentimes, if you have investment that isn't really backed by a traditional income when it comes to lending, something maybe more commission based, you may only qualify for a DSCR loan. And that's something where the lender will really care that they make their money back. I mean, they're going to care that they make their money back to start with. So let's look at the expenses that the property earns. After expenses, the property earns $24,000 a year. and the mortgage payments actually total $20,000 a year. So for DSCR lending, we're looking at $24,000 and we're dividing it by 20,000 and we look up and we see that we've got 1.2. So the property ends up making 20% more than it needs to cover the mortgage. So some examples we can look at is if we ended up doing that same math and we ended up getting a 0.90, which would mean that the property actually loses money before the debt. It's not even crossing the 1% line. 1% is it's just making enough to make the payment. And then 1.20 is a little bit more comfortable, whereas 1.50 is very safe. Banks like DSCR because it actually tell them whether or not they get paid. So those are some of the different ways that we can look at lending and how it matters. We break that down into the debt service. Debt service is just the amount that you're paying for the debt itself. And that's something you'll have that conversation with your lender when it comes to approaching that deal. Vacancy expense is something that matters a lot too. Let's look at it. We're paying a property manager 8 to 12% every year to manage that property. Well, if we have a vacancy, it costs us even more. I generally budget for about 7% annually for vacancy expense, knowing that 7% a year, there's a chance I may not have a tenant. That can consider turnover, that can consider just a slow market, not having tenants interested. All those things encapsulated to a 7% rate. Maintenance is something we should also consider too. Predictable maintenance, knowing that it's going to cost to actually own that property. So those average expenses of maintaining the lawn, cleaning the outside of the property, making sure that it's able to perform and be presentable at the same time. Capital expenditures are those large expenses. So we talked in previous videos about the roof being one of the most expensive parts of the property you can repair. So with the roof, that would be a capital expenditure. It's something you're going to be investing money in repairing or replacing to extend the life of the property. Those are things that you may also want to talk with your CPA about to see how you may qualify for any tax deductions, any benefits on the tax side of things for those capital expenditures. Taxes are also something that are very certain. They're hard to get rid of. I don't think they will be gotten rid of, but you will be having to pay them. And so on the tax side of things, we want to understand how much taxes usually are for those properties. The benefit is a lot of counties here in the US have a assessor site where you can look at what the previous owners had paid. You can look at the actual public data to know how much that owner has been paying for taxes. And then like previous expenses we've discussed, I would probably add maybe 5% to it just to know that it may cost you more, and then you've already rounded a very conservative deal at that point. Insurance is something that while some people may look at it and say, "Oh, I don't need to pay for insurance," you probably should. It's probably a good idea. Many lenders require that you pay for insurance on the property, and it is an expense. So speak to those three different insurance providers. Understand what they're going to charge for that property, given the age, the condition it's in, all those things, and understand what those numbers are. Net operating income is your income after all those expenses are paid. So similar to some of the other examples that we've given, um, which may not have considered debt, well, in this case, net operating income, we're going to consider debt. We're going to consider all those expenses that are paid, put all of it in line and know what we're making at the end of the day. And that's how you really understand what that true cash flow is. Some investors take the wrong road and they look at it what is more so phantom cash flow. It's a cash flow that's not actually there because they have principal, interest, taxes, and insurance that have to be covered. It isn't just what do I have to pay for my mortgage and what am I making on income from rent. You have those other expenses that have to be covered. So once we've considered all those different metrics, you can really look at it and say, I know how to tell a good deal from a bad one. And that's something that you will have to do many, many times to be able to find that right deal that actually makes sense. And after you get to that part, you're ready to move on to the next part of the process.